Hello, everybody, and welcome back to another episode. So the clear story this week that's been grabbing the headlines has been the demise of Silicon Valley Bank, the bank which specialized in lending to tech startup companies, but has since failed and been shut down by the US regulators. So, Guillaume, what's been happening with that bank? What caused it to fail?
So, yes, Tom, last Thursday, 9th of March, in a single day, investors and depositors into Silicon Valley Bank tried to pull 42 billion in one day. So that's a classic bank run where clients all want to get their money back all at once, and the bank simply doesn't have the money. So when the money runs out, the bank regulator steps in, and the game is effectively over for SVB.
So why did the clients want their money back then? What prompted them? What prompted that run?
Well, it looks like, as you said, potentially SVB had too many clients in the tech sector, and that's a sector that's been slowing over the last few months, and so companies have got more cash needs to run their operations. And it transpires that those bank deposits were actually tied up in bonds that had lost value over the last few months because of that important rise in interest rate that we've seen. And that's something that could have been avoided. So it's quite specific to a failure of risk management within SVB. But then, when rumors start to circulate that the bank may not be able to pay their investors back, it really adds fuel to the fire.
So whenever people hear about banks failing, it sends a bit of a shiver down people's spines, and it's like an echo of the 2008 global financial crisis. And even today, we're recording this on the 15th of March. And other banks, Credit Suisse, they've had a hit to their share price. So the question really is, do you think what we're seeing here is indicative of a wider problem, some sort of banking crisis, or is it more contained and it isn't something we should be too concerned about?
The market's certainly concerned about contagion here. Our best case is that things will calm down. It's hard to compare that to 2008. It's not a widespread credit issue where you didn't know which bank was safe back then. We've seen very quick actions by regulator, that should help sort of stabilize things. But yes, still, it's a good reminder that, some banks can be irresponsibly run and that higher interest rates hurt and will always expose those areas of weakness and vulnerability in the economy.
And given that interest rates are starting to expose those weaknesses and vulnerabilities, as you put it, do you think that means that central bankers then will start to take stock and think, actually, maybe we don't want to increase interest rates too much because it's going to be harmful for the parts of the market and the economy? Or do you think they're sort of hell-bent and they'll just keep on increasing interest rates because they've got a big inflation problem that they need to tackle?
Yeah, it really puts them in a tough place here. They're definitely going to have to be more cautious about interest rates because, ultimately issues in the banking sectors can have an impact on businesses and jobs across the economy. But, inflation is still very high and they need to stay ahead of that. That's their primary objective. So it's going to come down to what sort of evidence we're going to get in the coming weeks of, further, banks' instability and the economic impact of that.
Guillaume, that's all for today, but thanks so much for your time. I say that every week, but I think I mean it even more this week because I know that the markets are particularly volatile, so you've been very busy. And of course, thanks for you for watching and for everyone else on the line, and we'll be back again next week with another episode.